All right, welcome everyone. It is June 27th, 2025. I am Dave Martin, COO of Build Asset Management. With me is Matt Dines, co-founder and CIO of Build. We're here today to talk about dividends and income and the different strategies that are generating today in the market. So thanks for joining us, and we plan to do a slide deck for about 45 minutes and then take questions at the end. So please submit your questions as we go. We'll probably hold Q&A until the end. So if you want to input questions in the chat, we'd be happy to address them at the end. So with that, Matt, how are you today? How's the bond market looking?
Doing great. Bonds are amidst a rally despite popular opinion. Bonds are unownable. Trend in yields has been down this year. Not a massive rally by any means, but it's just where we are in the cycle. Growth slowing, rates coming in. The dollar's a different story. We'll save that one for later. But that's generally how things are looking in fixed income today.
Great. Well, Matt, maybe we can give the audience a quick introduction to Build. Matt, as the co-founder of the company, do you want to just talk very quickly about Build's history?
Yep. So Build, we're an SEC registered investment advisor focused on fixed income and credit. We've been around since 2018. We have both public and private fund offerings. Some of our funds, such as a ETF, publicly listed, have obtained peer-reviewed Morningstar rating, that type of thing, that are at the 5-star rating amongst their peer group. And in 2022, we launched a private fund that specifically invests in Bitcoin-backed dollar loans. So if you dive into us on our firm, our background, we've been riding the Bitcoin wave for a while now. So that's just the general firm intro. Happy to get into more details about dollar income focused investing and choices that advisors and clients have in front of them in this environment, which will carry a lot of weight, I believe, on results over the coming years and decades ahead.
Absolutely. Thanks, Matt. If you want to learn more about what Build does, we're not going to go into specific details of our strategies on this webinar, but we encourage you to visit our websites that are product specific. So we have bfix.fund. That will tell you about the Build Bond Innovation ETF. It goes by the ticker BFIX on the New York Stock Exchange. And that's really on the public credit market side. And if you're curious about what we're up to in Bitcoin-backed credit markets, you can go to buildbitcoin.com to learn about BSIF1 or the Build Secured Income Fund 1. So, well, with that, we encourage you to, we'll put those websites up at the end. But with that, let's hop into the content today. So the title of today's presentation is, Are All Dividends Created Equal? Well, what's actually spurring this question, and the impetus for going deep on this content is that there is a trend right now. There's a growth wave going on in what at least Morningstar likes to call a category called derivative income strategies, and we'll generalize or make it a little bit more specific and say derivative income ETFs. This category has experienced 20x growth since 2014. So in just about 10, 11 years, it's gone from a $5 billion category with really just one player to a $100 billion category. What's unique is you're seeing this kind of this frenzied wave. If you remember, Wall Street goes in these trends. If you remember the SPAC boom a few years ago, 2025 is most likely going to shape up to be the derivative income ETF boom. You've got major players like Direction, they launched 71 filings to the SEC on a single day earlier this year. Okay, so what's so interesting about these ETFs? Well, they're daily liquid in an ETF wrapper, but they are advertising what I would call eye-popping dividend yields. So some of the bigger funds that track indexes, JEPI, JEPQ, QYLD, anywhere from 8% to 14%. The newer trend now is single stock single security derivative ETFs that are sometimes doing triple digit yields. So we'll get into that a little bit later, but this is a category that is experiencing high growth, and it's worth inspecting and coming up with a framework and a mental model to help advisors and investors think through whether these things are investable or you should be considering alternatives. So
I'm going to hop in with some color commentary here. 20x growth in, since 2014. That's over a decade, 11 years from where we sit today. 20x growth. What is that? That's over 4 doublings, right? All right. If you think about the last 10 years, what are some of the hottest trends? The Mag 7, Magnificent 7, Bitcoin, AI, cybersecurity, et cetera. 20x. The amount of capital flowing into this kind of niche as the search for income takes precedent, especially as you see a U.S. economy with demographics skewing towards 60s, 70s, retiring boomers, et cetera. It really shows you the momentum, the force behind this trend here. So I think, it's easy to just tout over. You see a 20x. We're used to seeing eye-popping numbers, but doubling now, closing out on its 5th time and just over 11 years. That's insane growth when you really step back and think about it.
Yeah, and I think Matt, you're going to get into in the next slide. I think Matt's going to get into some of the investor psychology and the market backdrop for why people want to go and reach for yield. Let's step back really quickly and talk about what are we talking about here? What is a derivative income strategy, and why is it different how is it different from a traditional bond contractual IOU strategy? Well, at a very high level, think of it this way. On the right side here, a contractual IOU strategy, that's going to be, a fund with treasuries, investment grade corporate bonds, maybe senior secured loans. Your dividend is mostly coming from cash from interest payments. So these are interest obligations that the fund is holding. Okay. Derivative income strategies. There's a dividend. It's for your bank account or your brokerage account. It feels the same every month or every quarter. It's paying out some dividend based on the amount of the security you own. The difference is in derivative income strategies. The cash is actually coming from the sale of options. So typically these strategies now, what they're advertising is they're saying, we're going to track an index or we're going to track a sector or a stock. So by that, I mean, we're going to track the S&P 500 or we're going to track, the NASDAQ 100, the Qs. But at the same time, we're going to pay a monthly dividend that's really appealing, and a monthly dividend that's much higher than the dividends, the equity dividends that are being paid, on that index. So it does this by basically selling call options or other option strategies related to the index or stock. We'll get into that in a little bit, but the goal of these things is to offer investors on the surface or on paper to say, you can take the ride of the Qs or you can take the ride of the S&P, but we're also going to give you a little bit more income than you're used to getting in a traditional strategy. So that really brings us, and I want to hand it back over to Matt, because he started to go down the road of, if you think about this, these are covered call strategies have existed for a long time, but not in an ETF wrapper, until the last 10 years or so. So the real question is, why these strategies, and why now at this point in history are we seeing 20x growth in this kind of thing?
Yep. So one of the many complaints against me, maybe I zoom out too much. I unapologetically, give this disclaimer. I love studying history. So I may go to a little bit too high level here. We'll bring you back down to earth, I promise. But I want to, take a perspective over the course of what most of us don't really see in our day-to-day, year-to-year type of um, uh, financial decisions we make typically on portfolio allocations. And I think I want to just start with the perspective of what have interest rates looked like over the course of just the lifetime of someone who is, let's say, 60, 70, 80 years today, who is really focused on uh, income, to provide for their, their living, their costs, their expenses, healthcare, et cetera, that they need to buy. So if you just start from their experience of, 40 to 50 years ago, if you will, 1980s, coming out of the great inflation of the 70s, and then we'll get into today and what's really prevailed and how people, how households, firms, et cetera, have approached financial assets for yield generation. So to start, beginning with the Paul Volcker Fed era in the early 80s, where if everybody's familiar with the history, to squeeze out the inflation of the 1970s, the Fed raised interest rates on the front end up to 18 to 20% at the highs, and basically held them there for 3 years. There was a couple of cuts. We got 400 bips of cuts. We went from 20 to 16 and then back up, which 4% cuts feels big, right? But that's 16% isn't that when people are clamoring for lower rates, going from 20 to 16 isn't really that. But you see on the starting point, so the high rates on the front end actually work themselves out to the long end of the yield curve. And what we started with in the 80s, where kind of the living memory of every investor who's still alive today really begins. Most portfolio managers from the 1970s, they're well retired past it. Yeah. You typically don't hear many perspectives there, just because people age out. But where most people's memories start, as in terms of their experience with income and yield on their investments, starts with that period of Paul Volcker, and that's where the boomers were really entering the workforce, getting married, having kids, buying their first house, et cetera. So when that person was, let's say, 25 years old in 1982, they started from a spot where they could earn high teens on it, even just a like a certificate of deposit, a savings account, stuff like that, a T-bill, or even a 30-year treasury. You've got the chart on the right, almost 16% on a 30-year. So what's the backdrop here? If you looked at the charts of debt to GDP, right, big topic today as we approach, some of the highest levels that the U.S. federal government has ever been in terms of the debt burden. Coming out of the 70s, actually, what we did was we ran it hot. You had high inflation, but growth actually kind of followed that rise in prices. And so what we ended up doing as we entered the 80s was we kind of squeezed out the last bit of the high debt to GDP burden that really peaked in World War II, the ramp up. And by the 1980s, we got debt to GDP down to like 30 to 40%. So turns out you can run high rates, 15 to 20% on funding rates, with the Fed funds rate in the economy. And your economy, just in a credit system, can pretty well handle that. Where you can't handle high rates is if you're indebted at 130% debt to GDP for public, federal debt, and try to rack up 15 to 20% rates on that, it won't work. Right. But in the 70s, running those high rates, or post 70s coming into the 80s, running those high rates, it was actually a great time to buy bonds. Reasoning for that, the growth in the economy was well above the interest rates. And so you had a tailwind of credit expansion. Even at those high rates, people were taking on mortgages. People were going to get auto loans, even at a 12% mortgage, 15% auto loans. They would do it. And even still, as a saver, you actually didn't have to take weird risks. Your savings accounts would just pay you. And as inflation was coming down, you were still earning a nice fat real return on
Yep.
low risk credit investments. So you start with the perspective too. 70s were not a good time for stocks. Gold had actually, if you look at the chart on gold, once Nixon administration repealed, there was all this stuff with the ending of the gold redemption window on the failure of the Bretton Woods system. But we also made it permissible. When you say we, the federal government made it permissible for the first time since Executive Order 6102 in the 30s for private households, businesses, et cetera, in the U.S. to actually own gold. So coming out of the 70s, you had a ramp up in gold. It had a blow off top in the early 80s as this rate hike squeezed out the inflation. Equities went through 15 years of just beat down from
Yep.
basically 1967 up until this same period, 1982.
Yeah.
And so
we'll talk about some of the risks related to long periods of equity staying flat or down a little bit later in the deck. Yeah.
So
Sorry, keep going, Matt.
gold rolls over as a store of value. The 1970s inflation, fire was put out, and this was the start of the era where, hey, you could invest in U.S. dollar credit, not have to take crazy risks. You could take duration risk, and you did extremely well. You could take short-term risk, you did well. You could take credit risk, you did well. Pretty much anything you did here in credit could work for you. Then this is where you saw the start of things like junk bonds, et cetera. Michael Milken in the 80s, the mortgage-backed security industry really start to take shape. But this is where the seeds really start in the 1980s and 1990s. And as we go into the latter decades, those things just start to, we're trying to squeeze all of the water out of that cloth to get all the growth we can on just using interest rates to reliquify the economy, get people to go out, take on more credit, generate GDP, rinse, repeat. But in the 2000s, we started to get what I view as in the zoom out view as kind of the end of that game. When we just lower rates every time we get into an economic recession or a slowdown, eventually you get less and less bang for the buck when you turn to that kind of weapon at your disposal or lever at your disposal. So this is the point where most people today can still recall their experience in the tech bubble or the dot-com bust, 9/11, and the downward pressure on rates. This is essentially like the window here of 2000s where interest rates were basically equivalent to economic growth. You start cutting rates or increasing credit, you're just slowing down the amount of real growth that you're getting out of the actual economy. And this is where, in my opinion, investors started hunting for yield, not just in treasuries, but venturing even further out on the risk curve to get that interest income that they'd kind of gotten used to in that experience in the 80s and 90s. So you see things like high yield bond markets, really like these things already existed, but they just ramp up. REITs, mortgage-backed security schemes. If everybody at this point is pretty familiar with what happened in 2008, but it goes into its heyday here, in my opinion, as we start looking to essentially conduct modern day alchemy, right? With subprime mortgages, package them into AAA tranches of securitized CLOs, stuff like that. Bundle up the tranches of CLOs into or CDOs into CDO squared, et cetera. And I think that moment was really the realization that, hey, this thing, we've squeezed all of the energy out of that system that exists now. And that leads us into the 2010s, where the natural point, if you study other societies in your history books that have been through a credit-driven expansion, they ultimately drive a credit bubble. You get to what I view as the accommodation phase, where the buck passes to the sovereign, institutions, and you had to start seeing central bank accommodation, treasury accommodation, et cetera, to basically deal with all of um, the kind of the waste energy that's been produced over 20 to 30 years. So this is where the Fed cuts rates to zero. We get a Bernanke Fed, who claims he's, studied the Great Depression as his, topic on his PhD, his all of his academic work. So we put that specific person in charge of central banking policy for this very reason. And this is the approach where, if you look at the last big credit bubble that the U.S. went through heading into the Great Depression, you try to fight the same war twice, right? It's never going to be exactly the same, but this is the approach. So coming after all of the kind of mistakes that academics and central bankers kind of realized they made in the Great Depression era and the aftermath. Well, this time the approach was, well, we learned from that. We're going to do the opposite here. So the Fed cuts rates to zero. We start doing the QE, where the central bank is actually absorbing credit onto its balance sheet. It starts with the treasuries. It's extended heavily into mortgage-backed securities, which really picked up in 2020 with the COVID rescue. And kind of that brings us to modern day, where we'll see how this goes. But in the 2010s, what the experience we generated was essentially like the safe income opportunities that existed in 1980s, 1990s. Those underlying dynamics were gone, yet people are slow to realize when the going's not good anymore. They still try to attain those results that they could experience in prior decades of their own lives. It's very difficult for people to see zoom out and realize that history is kind of just progressing on the scale of their own lifetimes. So this is where in the 2010s you start to see things like junk bonds, emerging market debt, dividend paying stocks, or like business development companies. Investors start pouring into just different vehicles, different allocations to achieve dollar income to meet their own needs, right? You need money, and most people through their financial assets are focused on income generation to provide that in quote unquote the safer way, right? But what they end up doing is venturing out on the risk curve. And so 2020s, we've started to see the bottoming of that entire process from 1980 to 2020. My opinion, we're on the other side of that mountain. It's a different experience. But this is where we get into the things that are into the investments like today, where people are still kind of trained to follow those behaviors over 40 to 50 years, which is like the majority of a lifetime, and old habits do not die easy. So
I
this
think
is where
the prevailing
thing
today. Yeah, the prevailing thing, Matt, is that I think everyone's wired to eventually say, I want to put my money to work. I have money, now I want to put it to work for me. And that typically is just, we're wired to think, okay, I'm just going to invest somewhere, and then that capital is going somewhere productive. And whoever I'm giving that capital to, they're doing something more productive than I care to do right now in retirement or whatever. And I expect to be paid for that. And so that wiring is very hard to break. And yes, we have the analogy of sort of the WWE ladder match that you've got a suitcase full of money, and as the safe yield keeps compressing, you got to reach further and further out to get that. And Matt, I know you have some thoughts. Take us through this chart on some of the problems of this concept of we like to call it, reaching for yield.
Yep. All right. This chart, I'm just the study of high yield investments. So these are bonds, CUSIP securities that are essentially, contractual obligations, but they're a reach into the, non-investment grade rated corporate issuers. So Couple things to clarify here in the back. I've got in light blue a metric called the high yield option adjusted spread, or OAS. Essentially, you can think of this as like the extra yield over a treasury bond that investors require for compensation for lending into a risky business, right? And so these high yield spreads, we're not going to get deep into explanation of the credit cycles, but what you see every time these credit spreads spike, that's your bottom of your short-term credit cycle, right? There's boom and bust. We can go into a long webinar on the business cycle, the credit cycle, et cetera. I'll save you that. But every time this credit cycle bottoms, you'll see a top, like a surge in those credit spreads, because this is when the economic growth slows down. The chairs have all been pulled away from the dance floor in the musical chairs analogy, and the music stops. So your yields increase, which means the price of these bonds, drops, and then the Fed will come in, policy will come in, et cetera, to basically accommodate, get the business cycle up and running again. So you see these kind of cyclical tops. In 2008 was the big one. That one stands out above all others we've experienced in our lives. But also 2012, 2016, 2020, and then as we're getting into today, is there another one of these? Well, the answer isn't like yes or no. Like in the short term, like will we have a recession this year? Will we see a credit spread spike this year? That's not a good way to think about it, in my opinion, because then you're trying to time these things precisely. But will there be another bottoming in the short-term credit cycle? Like the answer is yes. We will see at some point spreads do another one of these. Now, placing it in exact timing is have you seen talking heads on CNBC, financial media, et cetera, who are focused on, are we going to have a recession this quarter or this year, et cetera? That's just kind of a fool's errand. Don't focus your time so much there, as just the core kind of truth or lesson to learn out of this, which I want to get across, is every time we see a bottoming in the short-term credit cycle, the important thing here is if you track on the yellow line, that's your share price of HYG, the high yield bond ETF. It's been outstanding. It's been in existence since I think 2006 or 2007. So we've got almost 2 decades of history on this. But what the experience has been basically is every time you get out, or the economy, investors, we exit one of these, the bottoming of a short-term credit cycle. Once you move forward into the recovery, you see the stair step down on price here. And so what this represents, like think about that HYG share, that credit allocation you've made. Like that's your actual income earning asset, right? You get yield off of the price of your capital account, right? So every time we come out of a credit cycle bottoming, price will go down on these bonds, and then it'll recover as things stabilize, interest rates are back. But the experience we've seen now on these ETFs, we have a live, audited, all of that track record. The experience has been every time you get that sell-off, you go through the credit cycle, but then you recover, your capital account is now coming back at a lower level. So you just get continually eroded, depreciated. And if you think about this, think about your financial asset here. Right now on this slide reflected as HYG. Think about this as like your car. If you're, say, driving for Uber or something like that, it's like, okay, every time I have, from a day-to-day perspective, it looks like my car is fine, right? But once in a while, every few years, I'm going to have a major expense. Oh, tires need to go out.
Check engine light comes on.
Check engine light comes on. You have a major repair, costs money to go fix it. And then once you get it repaired, you're back on the road, but the actual depreciation on your car takes a hit. There's a noticeable decline in performance on, when you step up the gas. It's not accelerating the way it used to, until finally you're just, 10, 20 years later, it's like, wow, I've fully depreciated my car. This is what is really going on, this experience and credit investing. Your capital account is getting eroded the same way as we'll talk about with option-based interest or income focused strategies. But this is, one of those key risks as you realize that 1980s, 1990s experience of, hey, I buy T-bills, those safe credits, they keep your capital account, essentially whole or money good. This effect, as you have to reach and stretch onto credit, is real. So it's often ignored by advisors, retail investors, allocators, and it doesn't show up. Every day you don't get that depreciation charge showing up on your dashboard, right, of your car. But over time, it is a real cost, and it's very easy to ignore these because they take years to play out.
Yeah. Yeah. Well, and that brings us, Matt, to we're now in this period of time where it's the next hot thing, and what we think, I think our house view is this concept of reaching for yield is derivative income ETFs. So really quickly, we're probably not going to get too deep into the technicals of this, but I think we're using a shorthand for derivative income ETFs. They're not always, covered call specifically, but that's probably the best and easiest framework to understand these. So what's a covered call? Let's just say that you have 100 shares of Apple stock you've been saving up. You've been DCAing whatever and building your pile of Apple stock, but Apple pays a dividend, but it's not a robust dividend, and you want more cash income. But the key is that you don't want to sell your Apple stock. You want your Apple stock, but you also want more income. Well, what do? So you can do this if you're a sophisticated, even a sophisticated retail investor. If you check the box in your brokerage to say I'm aware of the risks. Well, you can start buying and selling derivatives. You can start buying and selling options. So how would I generate some cash income without selling my Apple shares? Well, what I would do is I will sell a call option, and you're going to have to pick your expiry date, and you're going to have to pick the strike price. But basically, you're going to sell a call option in the future on 100 of your Apple shares, and you're going to, when you do that sale, you're going to collect a cash premium. So all of a sudden, boom, you've got some cash income in your account. Now, a couple things can happen here. If the Apple stock goes up beyond the strike price before the option expiry date, there's a chance that your Apple stock is going to get assigned to that option. Well, what does that mean? That means that as the owner of the Apple stock and the person who sold the options contract, I am obligated to sell my Apple shares at that future price if it exceeds it. So I get the money, the proceeds from that Apple stock sale, but the problem is the share price has gone up. So I'm capped. I've now realized, whatever that appreciation on my Apple stock is, and any other further gains, that other party has now exercised that option. Okay, so that's typically not an ideal case if you really wanted to hold on to your Apple shares. If the stock stays flat or it goes down into the future and the option expires, then good news. You still have your Apple stock, and you've never had to give away that cash. That cash was yours at the beginning. So you've got your Apple stock, you've got a little extra income. Life is good. Okay. So these derivative income ETFs, what I just described to you, it's tricky. You don't get good execution prices as a retail investor. And there's a lot of just managing the risk of it. You if you're going to do it well, you're probably going to have to do it quite a bit of your day. So the derivative income ETFs have taken this idea of selling options against your holdings, and they've packaged them up into an ETF wrapper, and that comes with a lot of benefits, right? These are managed by big institutions with professional portfolio managers, a bunch of people sitting at the desk with Bloomberg terminals. And they package it into one wrapper. The other thing is that it's liquid. You can buy one of these ETFs tomorrow, And in a couple months or whenever you want, you can sell it if it's not working out for you, and you don't have to mess with any of the mechanics of options. So, well, why do people like these? Well, in theory, marketed, you're getting exposure to some reference asset. Maybe it's the Nasdaq, maybe it's the S&P, but you're also getting these monthly payouts. And if you go back and think about what Matt was showing you in the 1980s and 1990s, even though a lot of people now are probably not remembering those days, they're still thinking, oh, great, I can hold my S&P holdings or my Apple or whatever. I can get exposure to this asset, but I can also get these really nice yields that are helping me keep up with cost of living. And so that's it. So we'll go through. Actually, let's take you through a little bit of the history here, the timeline of these product launches. So the first ETF that was doing covered calls debuted in Canada. The company was called Horizon. The one in the United States that most people have heard of, because it's 12 years old now, is QYLD, and that was launched by Global X in 2013. So we'll do a little disclaimer here. We're trying to give you a framework to understand these vehicles. We're going to talk a lot about QYLD specifically because it has 12 years or 11 and a half years of track record. I don't want viewers to think we're picking on them unnecessarily or promoting them. It's just that's the one. If you're going to go and look at how these things work over time, recommend you look at that one because it's been through a few market cycles. The real boom didn't really pick up though until the late 2010s and ramping into COVID. 2020, JEPI launched, and now we're just in a boom time here. And Matt, you could probably talk about this a little bit, but if you look at the chart on the right, this chart is showing basically options volume, right, Matt? And is this the tail wagging the dog, or is this just the same story?
So, some degree, it's product market fit. You've got credit expansion. You've only got so many shares on the index itself. So those. That new credit creation just coming through expansion and, outstanding debt in the system has to keep flowing somewhere, right? It's flowed into real estate. It's flowed into equities. This is one more layer, right? It's flowing into the options layer itself. And it comes from, it's like, where does that credit creation go? Well, ultimately, like the market is going to create the products to match supply and demand. So which one's the tail, which one's the dog? I start from the framework of the credit system itself, and this is an output of that.
Yeah. I think if you mapped out the growth in derivative income ETFs and the options activity, it's gonna correlate. And that's trace it back to the credit system. So here we are. It's 2025, and we talked about the golden age of bonds earlier. And maybe this is what you call the golden age of derivative income ETFs. And like I mentioned earlier, this is a $100 billion market. And if you look at the launches going on right now, go on social media, go on Reddit, Instagram, you will find no end of influencers and posts and commenters who they don't work for these companies. They love these things. They're promoting them in terms of, hey, I'm making this income. This is how I'm stacking my income. But this is the top 10 on this table alone. So we talked about JP Morgan's products, JEPI, JEPQ. Those became very popular kind of coming out of COVID, QYLD. What's interesting here is that the majority of these ETFs on this chart are still tracking either an index or a sector. But you're going to notice that there's a new phenomenon now. We talked about this earlier with YieldMax launching 71 products in one day. You're starting to see more exotic strategies that are targeting single stocks. So YieldMax has a MSTR. If you're not familiar, that's a company called Strategy. They're famous for becoming the first big proponent of Bitcoin treasury operations, issuing sort of fiat securities to acquire more Bitcoin. We'll go there on this one, but it's run by a man named Michael Saylor. So we'll get into that one a little bit later. But maybe what we do here is switch over. This is the landscape. This is the top out of that $100 billion market. I want to walk through the investor experience if you for the top three of these products. So we're going to start with JEPI and we're stack ranking by AUM. Now, if you think about investor experience, my belief is a lot of people are focused on that monthly coupon. So they're saying, hey, I invested in JEPI a month ago, and hey, look, I got a whatever it happens to be, a 9%, 10% dividend at the end of the month. So you think, okay, fantastic, that's great, I like that. Well, we tend to think of investor experience in terms of total return over long periods of time. So this chart is tracing since JEPI's inception in 2020 all the way through now, and the mountain chart, the blue chart, is the total return. So that's if you invested in JEPI and then you turn on DRIP, you turn on dividend reinvestment. So you get your coupon, and what do? You buy more shares of the ETF. So this is you're kind of building up your stack, and this is not considering taxation on this. So this is just a tax-free chart. Okay, so what do we see here? If JEPI is roughly benchmarking itself against the S&P 500, so we'll take SPY since that's a fee incurring ETF. What you'll notice immediately here is that JEPI, in a total return sense, is actually going to underperform the SPY by a pretty wide margin. I think it looks to be about 50 points. So in 4 years, you had a choice. You could get that income, which is baked into this blue chart, the blue mountain chart, but it's coming at the cost of, if you actually wanted to track that reference asset, you're lagging behind it, and you're paying the price basically for getting that income. All right, let's go to JEPQ. All right, that's tracking. I believe that's roughly tracking the NASDAQ 100. We'll benchmark it against the Qs. Again, it's the same story that I just said. It's a different index that it's tracking, but you're getting pretty much the same result. This is half the time, I think, maybe a little bit more than half the time that JEPI has been around. So it started in 2022, but you have the same story. You're lagging your reference asset or your index by 25 points. So again, similar story. Okay, well, what do we think the number 3 one is going to show us? Number 3 is the oldest, and I think this is where one of the principal risks we see with these strategies really becomes apparent. QYLD has been around since 2013, so you've got 12 years of track history to look. And Matt showed you the chart with HYG and kind of seeing this gap open up and sort of the lower lows, lower highs. Over a 12-year period in a covered call or buy right strategy, you're just going to continue to see that gap open wider and wider and wider as the reference asset, in this case the Qs. You're not having to give up any upside by selling that call, and that's where the reference asset is just going to slowly walk away from the derivative version in the ETF. So I could take you through 10 slides of the top 10, but I'm going to ask a question to Matt. Okay, Matt, among the top 10 that I showed you earlier of this $100 billion market, how many of those have actually outperformed their reference asset since inception?
I'm going to guess it's pretty rare.
Yep. You're going to be right. So if you look at this and if you go down to number 8, so all of them have lagged their reference asset, and in some cases it's a very big margin. But again, these are different inception dates, so this is for illustrative purposes. You can't benchmark these one-to-one with each other. But I think the one that's really interesting is number 8, and number 8 is TLTW, which is a buy right derivative income ETF based on TLT. If you're familiar, that is the ETF that holds the long bond 20 years and out. And Matt, I think you could educate us a little bit, but the long bond has not had a great go of it in the last couple of years, and we're just going to throw the chart up here. This is TLTW versus TLT. And TLTW was launched in August of 2022. And Matt, maybe just educate us a little bit on what has happened since 2022 to bonds and why this is down.
Well, basically, we talked about the 2010s policy approach. You do ZIRP, you do QE, et cetera. You cut rates to zero. The central bank absorbs treasury debt on its balance sheet. Basically what we've seen since the start of 22 has been the snapback, right? So the 30-year bond coupons got as low as 1.25 on a 30-year fixed income investment. And basically the experience since 2022 has shown, as we've let interest rates come up and, find their market driven levels, as central bank support stepped back. It's been a tough experience for all bonds, but chief among them have been the long duration bonds. So your 30-year, if you think about it, your long duration worked well for you from basically 1980 to 2020 when you had that tailwind. If you think back to that original chart we showed early on with rates starting at high teens, in 1982 and then just declining cyclically. Like clockwork for 40 years. It's been the opposite experience starting in 2022. So that's what's generally been going on in TLT.
Yeah. And if you look at this, when you go back and you look at the chart that I showed you here, the majority of these, if you look at what's been going on in these asset classes, with the exception of TLT, these things have experienced up and to the right, and so you're getting positive returns for both the derivative income ETF and the reference asset. But in the up, remember, you're capping your upside, so you're not getting you are paying for that income in some way, but they're still up, right? So you're not necessarily feeling that you made a bad investment from from that standpoint, but TLT, the fact that bonds, that you've had this shift in the bond market, it actually illustrates a little bit better what are the upsides of these strategies and also what are the risks. So these things, remember what I told you before, if I have 100 Apple shares and I sell a call option on it, well, if the Apple shares go sideways or they go down, I've actually done okay. I've actually beaten the Apple share price appreciation because I got some cash up front and then I got to keep my shares. So these strategies actually do outperform in down periods to an extent. Because you're getting cash income on selling a future call, your total return will be a little bit better. So in this case, it's outperforming on the downside. It's doing about 5 points better, less negative. So this illustrates some of the benefits, but I think it actually does a better job of illustrating the four principal risks that we see and the things that you should put into your mental framework when you think about how you're getting income. Number one, we talked about this capped upside. The second piece of it we'll go a little bit more into is that the yield is it's not a contractual obligation to pay this yield out. It's kind of financial engineering. It's engineered yield based on volatility. The third risk is, unlike a bond or some other contract, you don't have downside protection. So Matt mentioned earlier, the term lost decade or lost period of time can apply to different historical events. But if you go into an extended down period in your reference asset, equity market, whatever happens to be, you don't have any downside protection in these funds. So they'll keep spitting out income, but you're riding this down and down and down, and your principal balance and your NAV is eroding. And that brings me to the fourth piece, which is you're always, no matter up or down, you're always going to be eating NAV and eroding that principal over long periods of time. Let's go in and walk through these really quickly one by one. We've talked about this a few times here, but the first risk is This chart is basically the if you have a buy right strategy and you have a long stock, and we used Apple earlier, this could be NASDAQ 100. That blue line is representing the buy right strategy or the derivative income strategy. The green line is the whatever your reference asset is, and the yellow dotted line that's the strike price of that call option you've sold. So this is just showing you the line of when you cross that strike price and the option is still good. That's it. That is your appreciation of that asset. Now, this is a very simple illustration. In these ETFs, these things are being rolled constantly. So it's a little bit more complicated and probably don't have time to get into it today. But this is a good illustration of why your upside is capped, is that if the reference asset exceeds a certain point, the cash that you got for that option is now, like, you keep that cash, but the person on the other end is now able to purchase that reference asset at a price that's a little bit lower than they would get on the open market, which is good for them. They're going to make money. Matt, do you have any other thoughts on this first risk?
I think you covered it pretty well.
Okay. Let's go to the second risk here, and the risk is that the yield. We talked about this earlier. In a bond ETF or a credit-based ETF, the yield is an interest payment. Somebody owes interest on something. It could be mortgages, could be the United States government, it could be private loans, whatever. There's a legal contract. There's a stream of income that is supposed to be paid. Now, those things can default, especially if you're in high yield, unsecured credit, whatever. They can default, but the baseline is there's a steady payment. It's contractually obligated, and it might be collateralized. So we'll get into that. So on the right, that is your NAV. This is a hypothetical $150,000 senior secured loan. It's secured by collateral, and it's a year long. And so your NAV doesn't change because this is an interest only loan. So your NAV hasn't changed because it's a $150,000 loan, and your dividend is just the interest payment that you're paying every month. So this loan is 14%, kind of a hard money loan. So every month that person's paying around 1%, maybe a little bit more. And that's happening throughout the whole year until the end, the loan is paid off. Okay, let's look at on the left then. Your monthly yield now is dependent on the portfolio manager's ability to sell those call options, or they might be doing something. They might be taking some puts into account, but in generally they're going to sell an option on whatever assets they own, and that's going to be the cash that they use to generate that dividend income. So what you'll notice is two different things on this chart that's different from the one on the right. The first is that the NAV of the fund itself wiggles. It can go up and down quite a bit depending on, remember, you own in this case the Qs. Well, we know that those are pretty volatile, and so that NAV will go up and down as the reference asset moves. And your interest payment is also, it's not contractual, it's just dependent on how well the portfolio managers can manage their call selling strategy. So that's basically it, is that you don't have the contractual obligation, and you're really relying on manager skill to deliver that yield. Okay. Risk number 3. We talked about this a little bit with TLTW, but the option income is not going to, you can outperform in a down market in terms of performance to the downside, but it's still not going to save you in an extended bear market. So what I've done here is I lived through this in my working life. I started working in the year 2000, and that was there was a big tech crash in the stock market in March, and basically from March 2000 all the way through March 2009, if you round tripped it and you held the tech stocks, you experienced basically a journey to nowhere. You had a big crash, lost a ton of principal, but you held on and you kind of ramped it back up, and just in time to get, we like the term, rug pulled by the global financial crisis. So people who have been investing for the last 15 years, take COVID out of it and a few other events, haven't experienced one of these lost decades yet, especially in risk assets like, the NASDAQ. So what does that mean for something like QYLD? If you zoom in on QYLD, you will be able to see what happens over a shorter bear market period where you're going to have NAV erosion and total return is going to be down, even though you're outperforming. Okay. And that brings us to the last risk, which we talked about, is if you've been following these things, even though the yields stay high, if you just follow NAV, don't do total return, it's just going to keep grinding down and to the right. So you will have that NAV erosion. Matt, anything to add on this?
No, I think, it's very easy to get caught up in the short term. What is my interest income going to be this year, this month, this quarter? But over the long run, the real risk is killing your golden goose.
Right.
So keep that in mind.
Yeah. And last but not least, the single stock ultra high yield ETFs. That's the big trend this year. So we've been talking about things like JEPI and QYLD that are index linked. The big thing now is single stock or single security. So MSTY is just focused on strategy. We talked about that. It's juiced yield. So now you're seeing yields in the triple digits, and I would say it's juiced risk. So again, capped upside, but you now have very significant downside because these are typically being done on very volatile securities. Again, if you look at, and we'll get into this a little bit later, but a lot of the times the dividend is actually return of capital. So your NAV erosion problem is going to be greater. You've got most of these strategies actually they're not actually long any, they're not actually long shares of MSTR. It's purely derivatives. So you've got derivative and counterparty at risk. And again, just single stock exposure. So you're taking quite a big risk here with no guarantees. Okay, Matt. So I kind of went through risks here, and it sounds a little dour, but I think tying back to earlier, the investor is going to say, the advisor is going to say, I still need income, right? What am I supposed to do if I can't go do derivative ETFs? All right. So one of the questions I think people should be asking themselves is that if they are trying to get high yield or they're trying to get income, the first question is, why do you need daily liquidity? Why do you need the daily liquidity of an ETF wrapper if you are in an income phase or income focused phase and plan to just have this income stream going for a while? So ask yourself that question. Why do you need that liquid wrapper? Why do I need to be able to come and go? If you don't need to do that, you need to consider illiquid contractual strategies. So this is something, we mentioned this earlier, this is something we do at Build. We can't go down the road of the specifics of that, but I encourage you to check it out. But what you're going to end up in something like a private credit fund is you're going to get something that has maybe high single digit to low double digit yields. But you have the opportunity to be investing in something that's secured, it's senior secured in the debt stack, it's collateralized in a lot of cases. And what you need to trade off for that is you're going to sign in and say, I'm willing to invest my money for 1 year or 2 years or maybe even up to 5 years. But that's the trade-off you're making to have this contractual yield. And if you are an income investor, I'd encourage you to think, well, why do I need to be able to get out of this tomorrow if what my goal is income? Matt, any other thoughts on this?
No, I think these are hitting it, and these are really right on point with the questions that are coming in from looks like advisors and few retail investors who are in the audience.
Great. Awesome. Well, let's move on then. So the second piece of it is, okay, so you say I need liquidity. Okay, I need liquidity. Well, if that's a necessity, then you need to think, okay, you might want to consider a bond fund where you still have that contractual obligation, because this is still going to give you some of that downside protection in that the interest payments are legally backed up. Now, again, you're not getting 10%, 11%, 12, 15%, but you're better protected on the downside. So yeah, you're going to trade off. You might be getting net yield, 4 to 7%, but the assets are going to be treasuries, IG corporates, private loans, and you do have the liquidity. So, maybe in a lot of cases, this is, oh, maybe I'm going to put a down payment on a house. So I don't know when that's going to be needed, but I need to be able to settle in like a few days, right? So this is going to be a better option. Let's say you have, a down payment ready to sitting there. If you invest it in one of these derivative income strategies, you could suffer a big loss very quickly in these if the market turns against you. We've seen that happen this year, obviously, with geopolitical, volatility and headline risk. So that's another thing to consider. And here's the third piece to consider. And I keep harping and going back to this concept of you've worked hard, you've saved up some shares, maybe you got some Apple, Amazon, whatever. If you are long an asset like the S&P, if you're bullish on that over the long period of time, but you want some money to live, in a lot of cases, if you do the math, it's actually a better idea just to sell little portions of that asset that you've built up over time and continue to hold the rest. If you look at QYLD, I'm just going to pick on that again because it's been around for a while. If you just bought on the same day, you invested $1 million of whatever amount, doesn't matter. Let's say you had $1 million, you invested in the QQQ. If you took 8% out to live your life out of that investment every year, sold every year, up until now, you'd be making over 160, maybe $200,000 in income or returns. You would still be ahead of QYLD before taking any of the actual dividends from QYLD. You're actually beating QYLD's total return, not earning any income because you're plowing it back in drip, just by taking down some of that principal. You're just, and again, this is a case if you're bullish on the reference asset, why are you capping your upside by selling calls just to get some income? So again, that's an opinion here, but it's pretty well backed up if you look at the math on the back end. You've got to really think through this.
So your right tail is doing the majority of the heavy lifting on your returns once you zoom out over multiple years of compounding. That's what this is really illustrating. 8% withdrawal rate. I think if you're an advisor in the audience, this should be like a wake up call, shocking type of result.
Absolutely. And 8%, by the way, if you're a follower of the FIRE movement, financial independence, retire early, it's very popular amongst younger generations. Their benchmark has always been 4%. So you build up a pile of assets and then you take out 4% a year. So I actually had to find the withdrawal rate that would actually get it almost even with QYLD's total return, and it was double what they're recommending. So take that as it is. So
you can live high on the hog.
Yeah, you can. Well, let's. I want to get to some of those questions, Matt.
Yeah.
So let's finalize this. Just I want to leave the audience with a framework when you're evaluating dividend investment. I understand everyone gets it. Like, people need income to live. They want to put their money to work. Okay. So with derivative income strategies, you are going to get a high dividend payment. In a lot of cases, you're going to get exposure to some reference asset that you may like. You might be bullish on it. And they're liquid. They're in an ETF wrapper. You buy it today and you realize you made a mistake, you can sell it tomorrow if you want. And the last piece of it is if you are already doing covered calls on your own holdings, like, this is much easier, right? This is far easier and probably cheaper. You're getting better execution by using one of these strategies. The things you need to consider are capped upside. So if you're bullish on that reference upside, you're missing the right tail, as Matt just said. Total return is always going to lag in rising markets. It'll beat in down markets, and it's going to assume no prolonged bear market, right? If you assume there's going to be a prolonged bear market in an asset, you probably shouldn't invest in it anyway. And then on the right side, contractual IOUs, think about this. Like, do you need liquidity? Well, you're going to get, modest to low double-digit dividend payments. Some of the vehicles aren't liquid, but there's more certainty of return of capital. They're backed by obligations. They're less volatile. And again, you're not going to get all that juice, but you are going to have quite a lot less risk. And again, credit markets are not immune from risk. There are credit market dislocations that can lead to big problems as well. But that's the framework that I want to leave everybody with as we go into questions. Matt, anything else, or you just want to go to Q&A?
Let's just hop into a couple of questions. I've got
Great.
one here from an advisor who's getting client questions about the income topic. I mean, it seems like almost every day, and I'm sure that's the experience for most financial advisors, especially those whose kind of practices or client mix skews towards late working career or in retirement. So this question: how should I frame the risk return comparison between say a high quality dividend ETF versus covered call strategies or other yield products for clients who prioritize income stability over growth? All right, my answer here, Dave, you can chime in on this. This is a difficult environment, like this phase we find ourselves in right now on the big picture journey of where we're at in the credit cycle. And I think what people are looking for here is the perfect one size fits all approach. And my answer is there's no silver bullet, there's no perfect way, right, to get that income, which everybody who isn't earning a paycheck or has real property or a business that's generating income, how do you get that interest income out of your savings or your investment portfolio? It's a tough question, and the answer here is there's no one size fits all, there's no silver bullet, but there's certain things that are sensible and make better sense than other approaches, right? And this problem's not going away. You think about, hey, as obviously bond yields themselves in a nominal sense are higher, but inflation is, while it's come down from that, the spike that we saw from 2021 into 2022, it's easing. If you look at the CPI metrics, it's somewhere mid twos year over year. This is still an above I guess average, in the sense that average is based on our prior life experience of 1980 to 2020 for US based investors. 2% is not average now, and that's getting more and more crystal clear ever since that Jackson Hole, Jay Powell kind of speech where August 2020 he made the big kind of proclamation, we're going to do average inflation targeting towards 2%. We're nowhere close to 2% average, and that risk just continues, in my opinion, as we kind of head into the future. So my answer here, all right, risk return comparison, just plotting these in the standard. When we say risk return, we mean average return and average standard deviation of what's backwards looking in the data. That's not going to be, in my estimation, a good kind of anchor to tether your analysis or your investment allocations to for what lies ahead. So what we talked about here is you reach for income. I mean, everybody needs income in their portfolio, right? If we talked about it, if you're retired, the only thing you can do if you don't want interest income is go live in a monastery, go live an astute lifestyle. But most of us don't really want to do that. That's not what we feel like we signed up for. So my opinion here, if you think, all right, if you're making the assessment, say, I don't want the core of my portfolio to be in a bond or an IOU. I'd rather have that NASDAQ or S&P 500 exposure, more of that, and I want to squeeze more yield out of those investments. Just be aware that over the short term, if you choose a derivative-based income strategy, you're actually giving up leakage over 5 years, 10 years, 20 years, et cetera, however much horizon is in front of you. So make sure you're weighing, those factors in to that risk return comparison. And maybe that's also a good perspective with clients too. At this point, we have enough real world track record data on these investment funds. And I think this is where the client positioning gets in for that honest conversation. This isn't a 1 year journey. Most of our time horizons are, longer than 1 year, despite the over kind of indexed focus of these allocation decisions tends to be, what's my interest income going to be this year? Try to think longer term and really understand the context that we find ourselves in today with the backdrop of just financial markets and where we are on the big picture.
Yeah.
All
Yeah.
right.
Nothing to add on that one, Matt. Good work.
Okay. Should we do one more?
Yeah, I think maybe take one more and then we'll sign off. We might be going a little over.
All right. We didn't dive into this topic, but we got a question on tax efficiency. So
Okay.
this advisor says, I've been recommending dividend ETFs to retired clients for steady income, but I'm seeing these ETFs like covered call funds show return of capital on their 1099 forms alongside the regular dividends. Can you explain how this affects a client's tax situation differently than a traditional dividend paying equity ETF? And should I be concerned about funds that consistently distribute return of capital?
Yeah.
You want to take that one, Dave, or you want me to
Well,
talk?
yeah, I mean, I know you have some thoughts on this, and I want to be careful we're not we're not CPAs giving specific tax advice, but I think I first of all, when you see return of capital, that should raise, in my mind, that should raise a red flag, because what you're saying is I invested $100 with you and I got a $20 dividend this month. And that 1099 or whatever that statement was mentioned in the question is saying, well, that's a nice 20% distribution there, dividend, but $10 of that was you just giving me my $10 back. So before you even go down the tax implications, I'm going to go down just the philosophical implications of that seems like a great business to be in, to give somebody a 10% dividend when I just give them 10 other dollars back. And we talked about this before, but that is going to accelerate NAV erosion, because you're not just losing with capped upside and not getting those higher highs in a covered call strategy. That's even more exotic, where you're getting some money just returned to you as cash and your NAV is going like this. So that maybe that wasn't a tax answer, Matt. Maybe you can fill in some of the blanks on taxes, but that's my first answer. That should be a red flag.
Yeah. So to put this back in the analogy, we talked about your golden goose. Your golden goose is your investment portfolio that's supposed to deliver, golden eggs, right? And you live off the eggs. If a distribution isn't, income based or like an equity dividend, payment, your distribution, if it's return of capital, that's not getting a golden egg. That's literally you're being handed, like, the butcher chopped off the wing of the goose, and over the long term, that's not good for the health of your goose. To make a gruesome analogy, but that's in effect what's going on. So just from this perspective, be aware, like, if you are actually, being given or being distributed returns of capital, what you're effectively doing, it's lowering your cost basis over time, which could be just building up a bigger tax bill in the future when you do have to take that sale or distribution. So you're lowering cost basis, just assuming your reference asset is maintaining itself. It's going up into the right over time, which is why you would want to own something like this in the first place. You're actually just moving that tax liability into the future. And if you're not aware of that, just make sure you're addressing that and fully informed on what's actually going on. Because yeah, as this advisor mentioned, those boxes on your 1099, they're not all created equal, despite, hey, a distribution yield. It looks eye-popping, looks fancy if you just put it on the front page, but make sure you understand the implications for yourself and for your clients on what each of those boxes are actually implying for the financial health and just situation for an investment portfolio over the long term.
Yeah.
All right. I think those are, two great questions. We've gone over on time, and probably don't have time to address more, but great feedback. Thanks for the audience for chipping in those questions.
Yeah, good stuff. And we'll be back. We'll announce another webinar in the near future. So hopefully we get more great questions. Encourage you to visit our sites to learn more about what we do. Again, public credit markets, we run an ETF called Build Bond Innovation ETF, BFIX, BFIX. That's bfix.fund. If you're interested in our private markets products, private credit, it's Build Secured Income Fund 1. You can find that at buildbitcoin.com. So definitely go check us out there. You can also email us if you have questions or comments at info@getbuilding.com. And thank you again, everyone, for joining us. Have a wonderful weekend and a great 4th of July holiday coming up. Matt, thank you for your time, and we'll see everyone again soon.
Great. Let's put the disclosures up on the screen here. We'll keep rolling. Thank you for your time today. It was a pleasure.